What is leverage? Forex traders can use leverage. This term refers to the use of borrowed funds from a broker to increase the potential return on investment. By using leverage, a trader borrows additional money to invest beyond his or her own capital. In this way, the investor is able to increase his potential returns. The fact is that the return on investment is calculated based on the entire amount, including borrowed funds. Leverage has risks. If the investment turns out to be unprofitable, the trader still returns the funds borrowed from the broker. This can lead to losses. Using leverage increases the degree of risk. Even small changes in the value of assets can greatly affect the overall financial situation. Leverage is usually denoted by a ratio. It shows how many times the borrowed funds exceed the deposit. Deposit, aka margin, is the amount a trader must deposit in order to use leverage. For example, there is an account with a leverage of 120. The trader makes a deposit of $1,000. He can now leverage $20,000. This is exactly what leverage is for. With its help, you can significantly increase the potential profit. The downside is that along with this, the risks increase commensurately. The most common leverage ratios. Using leverage, a trader is limited by its ratio. A trader can choose from 1 to 1 to the maximum ratio, for example 1 in 100. However, the easiest to calculate values are often used. The most common leverage ratios are 1 to 1, 1 in 10, 1 in 20, 1 to 25, 1 in 50, 1 in 100. In addition to these values, other values can be used. For example, 1 to 33. However, they are not so convenient in calculations. With a leverage of 1 in 10, it is easy to calculate the potential income. With a leverage of 1 to 33, the task is a little more complicated. Also, the amount of leverage depends on the market. Countries can limit the amount of leverage. The type of market also imposes its own peculiarities. For example, on a currency exchange, 100,000 units of the base currency, such as the euro, are bought at once. Because of this, a trader needs to have 100,000 euros in his account to start trading. This is where a large leverage comes to the rescue. With its help, it is possible to trade with 1,000 euros of deposit, as with 100,000 euros. How leverage is used in Forex trading. Leverage plays an important role in Forex trading. It allows traders to manage larger amounts of money than they have in their account. This allows traders to increase their potential profit. The main advantage of leverage is its main disadvantage. By increasing the potential profit, the trader proportionally increases the potential risks. That is why leverage should be used with maximum caution and understanding. Using leverage, it is worth paying attention to the risk management strategy. Since leverage allows you to free up some of the trader's capital, you should take advantage of it. Diversification, low leverage and stop losses are good options to reduce risks. In addition, reliable and regulated brokers should be chosen. They should provide adequate trading conditions and information about the risks associated with leverage. Limitations on leverage ratios in different countries. Leverage ratio restrictions can vary from country to country, depending on the financial system and regulatory policies. Here are some examples of leverage restrictions that may exist. USA. In the USA, leverage in the financial instruments market is regulated by the Securities and Exchange Commission (SEC) and the Federal Reserve (Fed). Leverage limits in the stock market are typically up to 2:1, which means that an investor can borrow twice as much money as they have in an account. However, there may be tighter limits for certain instruments or account types. European Union. In the European Union, leverage limits in the financial markets can vary from country to country. Some countries set limits on their own. Typically, leverage limits in the Forex market range from 1 to 30 to 1 in 50, depending on the currency pair. Japan. In Japan, Forex leverage limits are set by the Financial Supervisory Authority of Japan, FSA. Typically, the limit is 1 to 25. This means that a trader can borrow up to 25 times the size of the deposit. Traders should familiarize themselves with local rules and regulations before using leverage in the financial markets. How can leverage be used by unscrupulous brokers? Fraudsters may use leverage to serve their own interests. This can pose risks for traders. Let's look at the popular techniques of unscrupulous brokers. Fraudulent brokers may offer very high leverage, attracting traders with promises of large profits. Scammers may withhold important details or bias information about possible losses associated with leverage. Unscrupulous brokers may include hidden fees and terms and conditions in their leverage contracts. These may include high interest rates on borrowed funds. or hidden fees that increase the trader's costs and reduce their potential profits. Some unscrupulous brokers can manipulate prices in the market. When leverage is used, this has a proportionately greater effect. This can include distorting quotes or programmed trades to unfairly benefit the broker at the trader's expense. As a result, the trader may face loss of confidence in the market and finance. It is important to be cautious and choose reliable and licensed brokers with a good reputation. Before opening an account or using leverage, traders should carefully study the terms and conditions and policies of the broker, as well as read the reviews of other traders. This will help to avoid problems associated with unscrupulous practices of brokers and protect their interests in the financial markets. Leverage is a flexible tool that is useful in the arsenal of an experienced trader. However, careless handling of it can lead to huge losses. That's why beginner traders should master it on a demo account. Besides, you should remember that Forex leverage can and should be used only in conjunction with a risk management strategy.